Good morning, everyone. Welcome to SB July webinar, where we will be discussing tax law within the real estate industry. I'm Abduraghmaan Farao, and I will be your presenter today. This is on the first slide that you'll see on the screen. That's a bit of a background. I studied at University of the Western Cape, where I obtained my LLB degree. And thereafter, immediately after university, I joined SARS, where I was a member of the legal council and where I developed my niche for tax law. So today before we start, I just want to go through a couple of house rules, and all participants must please mute themselves and remain muted for the duration of the webinar. The meeting recording and the CBD certificate will be made available after the session and be shared subject to our attendance policy. The presentation slides will not be made available at this as part of our intellectual property. You can find any of our brochures and handouts on our website. This is at www.stbb.co.za brochures. Please post your comments and questions and queries in the chat. We have limited time, so we will try to attend to all your questions. For any administrative queries or feedback, please email marketing1@stbb.co.za. I'm not sure whether you're familiar with this phrase, but it's quite popular. They say nothing is certain but death and taxes. And this is absolutely correct and accurate. You cannot escape life without paying taxes. While you may be able to avoid declaring or paying certain taxes at this point in time, SARS will certainly collect those taxes at date of death. And since we can extend this definition now to include the interest rate, which increases every single second month by SARB, despite the fact they gave us some relief last week and did not give us additional increases. So for today's webinar, we have 4 key concepts that we will be discussing. The first concept will be what is considered a resident for tax purposes, and for SARB, the focus will be on those particular 2 institutions. And because when you deal with property, when you're in the property industry and you're selling property, especially when you're non-resident, this definition can take you on a roller coaster when you deal with SARB and SARS. And it is of paramount importance that you know what concept do we look at to determine whether you're a resident or not. Whether you're a estate agent, a conveyancer, paralegal, buyer or seller, what we will be discussing today will be of utmost importance to you because it will assist you in determining your tax liability. Once we've discussed tax residency status, we will go over into inward and outward transfer and how greylisting impacted this. That will be followed by a brief discussion on CGT, capital gains tax, and we will end off with withholding tax, which is of importance to our non-resident clients and those who are currently online and wishes to purchase property in South Africa. So the slide currently on the screen, it is what is a resident? These 3 different institutions that I am referencing here. We're looking at Home Affairs, SARB, which is South Africa Reserve Bank, and SARS, South Africa Revenue Services. So when you look at Home Affairs, I will not go into detail with Home Affairs because it's not of importance for this webinar today, but that is the status the conveyancer is usually concerned with when they draft the transfer documents. However, the technicality comes in when you deal with SARS and SARB. I will look at SARS first before I go on to SARB, because SARS is a more technical definition of what is considered to be a resident. In South Africa, there is 2 concepts that SARS use to determine whether a person is a tax resident for South Africa. The one concept is what we refer to as ordinary resident, and the second concept is physical presence test. So how do you define ordinary resident? Unfortunately, there's no set definition within our law to define an ordinary resident. We are guided by case law and the precedents set by the courts to determine whether a person is ordinary resident. With that being said, if you're born in South Africa, if you live in South Africa, you are considered an ordinary resident. But what about that person that left the country that is now working in the UK? This is where it becomes quite technical. So now, you need to determine, am I still an ordinary resident despite the fact that I left South Africa? The question is, there is a criteria, there's no set criteria, but there's various factors that you need to look at to determine whether you are an ordinary resident for tax purposes in South Africa. For instance, how we guide it in terms of this definition or this concept is, do you consider South Africa to be your humble abode? Is South Africa the place you return to after your wanderings? Where is your financial interest? So there's no set criteria that can apply to each and every single individual, and it will be on a case-by-case basis. So in order for you to determine whether you're ordinary resident, you need to look at your affairs and you need to assess, do I ever have the intention of coming back to South Africa and consider this as my home? Because ordinary resident is the concept of ordinary resident is centered around the intention of the individual. And the second concept is what we consider to be the physical presence test. It's a very technical test. There's a lot of technicality that involves with the physical presence test, but to simplify things for you, and I'm not going to go in through the calculations of physical presence test, but to simplify things for you, physical presence test is basically calculating whether you've been physically present in accordance with the criteria set by SARS. However, you need to keep in mind that if you don't meet the ordinary resident test or the physical present test, or if you do meet one of the two, you can still be considered a tax resident subject to a specific double taxation agreement entered into with South Africa and the country where you now reside. So double taxation agreement, which we refer to as DTA, it's agreements that's entered into between the tax authorities to regulate the taxability of that resident who now resides in or have assets in another country, but you also have assets in South Africa. So despite the fact that you may not satisfy the ordinary resident test or the physical present test, you might be classified as a resident by operation of a double taxation agreement. This is important to understand because this impacts your tax liability. South Africa have changed in the way of how they look at tax residency and how they tax people. And if you are considered a resident, a tax resident, you pay taxes on your worldwide income. If you're a non-resident for tax purposes, but you have financial interest or any assets or whatsoever that generates an income and is taxable, then you will be only taxed on that income that is sourced from something in South Africa. So the income should derive from a source within South Africa, and you will only be liable for tax on that specific asset that generated that income. Now that we briefly discuss what is a tax resident or a resident for tax purposes in terms of South Africa Revenue Services, we can now go over to SARB, which is South Africa Revenue Reserve Bank. So this is much more easier to determine. So they have four categories. They have resident temporary abroad, foreign national, and non-resident. For today's discussion, we will only look at what is a resident and non-resident. A resident, basically straightforward, is a person that's in possession of a green barcoded ID, a permanent residency status permit, or they have an identity number. You might not have your green barcoded identity document, but you still have that identity number. A non-resident, on the other hand, is a person that is completely have no identity document, no permanent residency status. They just have a passport and they're not a resident of South Africa. It is important to understand these two concepts because when you sell your property and you want to repatriate money out of the country, this is where the status of residency comes into play. For instance, if I was a resident and for example, let's use an example. I'm going to use an example that at the age of 25, I acquired my own property. And then 5 years later, I landed my dream job in the UK. So now I'm going to leave South Africa. I'm going to work there. I signed a contract for 10 years. And I leave my stuff in South Africa. I leave my property in South Africa and I go abroad. I live in the UK. I go work in the UK. So now, a decade later, turning 40, I'm like, okay, they're extending my contract. I'm permanent. I feel comfortable in the UK. I'm going to reside in the UK. I'm going to stay in the UK. I want to sell my property in South Africa, bring those proceeds over and buy a property in the UK because I'm going to settle here. So now that automatically links back to you no longer have the intention of going back to South Africa to become you don't consider it as your humble abode. You don't consider it as the place you will return to after your wanderings. So that's the SARS aspect that comes in, and that's important. That is why it's important to understand what is meant by being a tax resident. But now to continue with the example, so you sell your property in South Africa, and you instruct the conveyancer, please make payment to my UK bank account, my foreign bank account. Unfortunately, that will not be possible. The reason being, you are in possession of a South African identity document. And we're not going to go into the financial immigration aspect in this during this webinar because that's a topic on its own. So I'm just going to deal with my discussion without looking at financial immigration. So you instruct the conveyancer, please repatriate my funds to my foreign bank account. Unfortunately, that's not capable. That's not possible because you in possession of a South African identity document number, permanent residency permit. What needs to happen now? How can I get my money out of the country if I have an ID number, or I used to live in South Africa, I live South Africa, or I obtain permanent residency status? Unfortunately, you are subject to getting approval from SARS. This is called Approval International Transfer, abbreviated to AIT. It is under the new dispensation, and the reason why I say the new dispensation is because this was introduced a couple of months ago. Previously, it was considered FIA, which is a Foreign Investment Allowance. This is an extremely daunting process because you need to obtain the clearance from SARS to repatriate the funds. SARS will need to give you a clearance. And to get that clearance, you are required to basically provide SARS with a list of all your assets, local and foreign assets, for the past 3 years, and there should be a value attached to those assets. It is extremely daunting process. Trust me, I attended to a couple of them, and it can take very long to get you. It's not a matter of I submitted today, I get my approval next week. SARS will do a extremely verify every single information that you provide them, and they will assess every single thing. And with the new process that was introduced a couple of months ago, SARS added the specific column where you need to declare whether you're a resident or non-resident. And that is the reason why we are looking at the status, because you need to know the implications that stems from residency status for tax purposes. So when you apply for the AIT approval, there's one specific requirement that requires you to state whether you're a resident or non-resident. If you indicate I'm a non-resident, SARS will then, another block that will pop up, and SARS will ask you to provide documentary evidence that you became a non-resident. And this is usually in the form of a letter issued by the foreign tax authority. So in the instance that I referred to, an example I referred to earlier, where we were speaking about you living in the UK, so it will be the UK tax authority that will issue you with this letter. You will need to upload that letter, but what you should keep in mind is that if I become a non-resident by operation of law, by operation of a double taxation agreement, I am responsible to pay SARS exit tax. So what is exit tax? Exit tax is basically the tax you pay when you cease to be a tax resident. A lot of people don't know this concept, and they become a tax resident by operation of law. They don't know the fact that they became a tax resident. They don't pay the taxes to SARS, the exit taxes, and they just continue paying taxes in the foreign country, the UK, for instance. When you apply now to repatriate those funds to get it out of the country, you're applying for the approval from SARS in order to repatriate the funds, and SARS picks up that you are now considered a non-resident. You provided the letter from the foreign tax authority to state that you became a tax resident on 10 years ago. You are required to pay exit tax on your assets about 10 years ago. So what happens in this instance where you had no idea there's something called exit tax. You had no idea that you were required to declare this to SARS and pay the exit tax over to SARS on your assets in South Africa, worldwide asset actually, because South African tax residents are taxed on the worldwide assets besides immovable property. That does not form part of the exit tax. The problem with that is that you will become liable for penalties and interest calculated from the date before you became a non-resident for tax purposes. So here they refer to this considered to be where you cease to be a tax resident, and those penalties and interest can be quite steep, and it can cost you a fortune at the end of the day. So that is important. Why you need to know what is a tax resident. When do I become a non-tax resident for SARS purpose, and what is the implications of becoming a non-tax resident? And I come across a lot of clients that have no idea they were required to pay exit tax on when they became a non-resident. And it is important for you to have your affairs in order and to understand this to prevent receiving a steep tax liability statement where you need to settle tax, where you want to repatriate funds now. And I believe that the modification, or it's my belief that when SARS modified the system and then when they moved from a FIA, foreign investment allowance, to a AIT, approval international transfer, this was part of the process of determining whether people accounted for the exit tax. I'm not sure whether you also noticed that there was some post that went around a while ago, I think more to the end of last year, where SARS wanted to introduce getting a permit to travel out of the country, etc. This can also be considered a mechanism imposed by SARS to regulate tax residents to determine when they became a tax resident in South Africa. And this refers to the physical presence test, because if you need to declare when you're going to leave South Africa, or need to get a permit to do that, they are gathering the sufficient information to collect the taxes where they can. And we all know that the purpose of SARS is to collect and optimize on collecting taxes for South Africa. They've been doing a great job, but they are improving on their systems and getting the taxes where they can. And this is why you need to know, at what point do I become a non-resident? At what point do I need to pay exit tax to SARS? But this also links into the conversation that we will have later on after the slide. And that is why we need to look at, and I need you to understand, what is a resident for tax purposes. So we'll be moving over to the next slide now. But to conclude on this particular topic of residency status, I explained to you what is the impact of your residency status when you want to repatriate funds and you're in possession of South African identity document or permanent residency status. However, this is not the case when you're a non-resident. And by non-resident for SARS purposes, I refer to you do not have South African ID, you do not have permanent resident status, you're purely here with a passport and you're a resident of another country. If you have a property in South Africa and you want to sell the property and repatriate the funds, as a non-resident, the only thing you need to provide SARB, South African Reserve Bank, or the authorized dealer on behalf of SARB, is to prove that you introduce the funds into South Africa. And this is what is considered to be an inward SWIFT receipt. As easy as that, a non-resident can get money out of the country without getting the necessary approval from SARS. Whenever a client asks me, do you advise that I get permanent residency status? Yes, it's a nice to have, but you also need to look at the other implications, especially when it comes to repatriation of funds if you do own immovable property in South Africa. So let's look at I just want to move this quickly. Let's look at a scenario for inward and outward transfer process, which links up with repatriation, the definition that we just discussed in terms of South African Reserve Bank, not SARS. So A and B are both non-residents residing in the UK. A, the owner of an immovable property in South Africa, contacts an estate agent to market his property. B, interested in investing in the property, finds A's property to be a suitable investment and submits an offer, which A accepts. The the two parties agree that B will pay A directly in the UK. The funds are transferred and the financial transaction takes place in the UK. 10 years later, B wants to sell the property and finds a South African buyer, C. C pays the purchase price to the conveyancer and B requests that the conveyancer repatriate the funds on the date of registration. B requires the funds urgently as he plans to use them to purchase a property in the UK. So what is the impact of transferring funds internationally in relation to the scenario described above? So it's not uncommon for a legal practitioner to get the question, can we settle the funds abroad? Do we need to transfer the funds to South Africa? We actually had the question during the week, and the answer is, while there is no current legislation that prohibits you from doing this, it's not advisable. And although there's no current, and the answer to this is, although there's no current legal restrictions on doing this, B will not be able to immediately repatriate these funds. An application to the South African Reserve Bank must be made through an intermediary and SARB approval must be obtained. The application process can be costly and time consuming. And trust me when I say it's costly and time consuming, because we have a matter where we are still busy trying to get approval from SARB, and it's been about 3 months. And it may take up to 6 to 8 weeks to receive a response. There's no guarantee that the application will be approved, and you're running the risk of losing the property that you want to acquire in the UK. So as an estate agent, as a conveyancer, as a paralegal, if somebody, or if even as a purchaser or buyer, if somebody asks you whether they can settle the funds in the foreign country when the property is situated in South Africa, your immediate response to that client should be, it is not advisable. Reason being, it can delay the repatriation of the funds when that new buyer wants to sell the property and repatriate the funds out of the country. Costly, time consuming, so do not advise any of your clients to pay funds abroad. So, let me just get over. Okay, so what should have happened? What should A and B have done? To avoid any potential delays in repatriating funds in the future, it is advisable for B to open a bank account in South Africa. The purchase price should be transferred from his UK account to the South African account. Once the funds have been converted, the bank will provide B with a SWIFT receipt, and this is more particularly the inward SWIFT receipt, and that is issued by the bank in South Africa. The purchase price should then be transferred into the conveyance trust account. This process is recommended in all cases as it creates a clear paper trail, and the SWIFT receipt will allow for quick and hassle-free repatriation of funds in the event of a sale in the future. There will be no need for SARB application, and the funds can be repatriated in a day or two. And trust me, when we refer to the inward SWIFT receipt, it is vital that you retain this document, or if you transfer it to the attorney's trust account, obtain the inward SWIFT receipt and keep this in a safe place. If you're one of STBV's clients, we have a phenomenal app where there's an e-vault facility on it as well. Once-off payment where you can have access to it for the rest of your life. Store all these documents on your e-vault, or in case you want to sell your property in the future, you go onto the e-vault, retrieve the documents, and you will have a hassle-free repatriation. If you need details how to access the e-vault, please contact marketing and we will be able to assist you. So this is just a process that we recommend. We don't say that you need to do it when it's a natural person, but linking to the scenario discussed previously about A and B, this is advisable. So what should the process have been between A and B? A and B signs the OTP. Agent informs the purchasers of the payment process and instructs the conveyancer, preferably STBV. The conveyancer refers the matter to tax at STBV. The tax department will get in contact with the client and obtain the necessary documents. Once the tax department receives the necessary documentation, they will contact one of the intermediaries on our panel. The bank account will then be opened and the client will be provided with the necessary information. Client can make payment of the purchase price to the said bank account, the funds will reflect and the intermediary will attend to the necessary documentation. And when we refer to the necessary documentation, if you're a non-resident, you are required to complete the BOP code and obtain the SWIFT receipt. In this instance, why we recommend this is because there's a clear paper trail and all the transactions that was done in your name. While the current legislation allows you to transfer the funds to the attorney's trust account, and the attorney can provide you with the inward SWIFT receipt, we cannot say that this will be the process in 10 years' time. So following a more sustainable process, a process that is more clear, there's a more clear paper trail, is always advisable. It seems more time consuming, but at the end of the day, you will save yourself a lot of costs. So once the intermediary completed the necessary documentation, will instruct the client and provide the client with the necessary. The client can then upload those documents, the inward SWIFT receipt, the BOP category code reporting documents, upload it onto the eVault. Once again, eVault SWB direct app of paramount importance. It will save you a lot of money, and then the client can instruct the intermediary to make payment of the proceeds to the conveyancer. This process is recommended. It's advisable to follow this process, but it doesn't mean that you cannot transfer the funds directly into the attorney's trust account. It is for your own good as a purchaser to follow this process and retain all the necessary documentation. And because at SBB, we strive to provide a one-stop service, and we want to ensure that our clients we can handle everything in-house or refer to a panel of intermediaries. Our intermediaries, the intermediaries that we work with will also assist you with the converting the funds, and they will also advise you about the exchange rate. Since the exchange rate is so volatile, we had to discuss this with the intermediaries, and they were more than willing to assist the clients in this. Once you transfer the funds to South Africa, you have 30 days to convert the funds. And in those 30 days, the intermediary will advise you about how was the market, what was the exchange rate, what was it like, and you can book a rate. And once it hits that rate within the 30 days, the funds will be converted into ZAR, and you can optimize also on the interest that accumulates in the bank account while the funds are still sitting in the specific bank account in your name. This process is tailored and drafted around a natural person. However, there is a tendency of people buying property or incorporating a company in South Africa and buying the property in the company's name then they transfer the funds from their personal bank accounts into the company's bank account or directly to the SBB trust account or the attorney's trust account. That results often in a quite burdensome process of getting approval from SARB. So when you incorporate the company in South Africa and you transfer the funds from your personal account to foreign personal bank account to the attorney or to the company's bank account, you are required to get approval from South Africa Reserve Bank. It is of paramount importance that you do follow this process because that company is considered to be a resident. It is considered to be in South Africa, it is a resident. So when you want to repatriate the funds in the future and you get in contact with the tax department at STBB, the first question I'll ask you, did you get approval from SARB when the funds were transferred to South Africa? If the answer is no, we now need to regularize that and make an application to SARB with the necessary supporting documents. And this can also be an extremely long process that can delay you from obtaining your funds or accessing your funds immediately. Once again, this is the process that is recommended by when it is between two parties. It is more, I would say that you are more obligated to follow this process when you deal with a company that you incorporate in South Africa to purchase the property. The reason for this also, the reason why banks are now, authorized dealers are now in SARB are being very pedantic about this inward SWIFT receipt is because of the greylisting. Unfortunately, the greylisting, you might think that the greylisting did not impact you. Unfortunately, it did. The bank is now enforcing the exchange control regulations, the authorized dealers, extremely strictly, and they will not deviate. Previously, you could get away with repatriating funds on a bill receipt. Unfortunately, the bank wants to see, the authorized dealers wants to see that you have the inward SWIFT receipt reflecting the correct information. And whenever I speak to a client about the inward SWIFT receipt, uh, they are a bit confused. Um, they will provide me with the documents issued by the foreign tax bank, by the Bank of the UK, where they transfer the funds from. Unfortunately, we require the actual inward SWIFT receipt issued by the bank in South Africa. Sorry, I'm slightly distracted because I just noted a question came through. I will address all questions at the end. Okay, so now that we discussed the inward and outward transfer of proceeds, we will now go over into capital gains tax. Capital gains tax. Capital gains tax is, I'm pretty sure you're familiar with, in South Africa, you pay tax on acquiring a property, and then you pay tax when you dispose of a property. When you acquire property, when you acquire right in a property, acquisition of property, you pay transfer duty as the purchaser. When you dispose of the property, you will pay capital gains tax. And capital gains tax is the tax that's levied on the profit made on the property. Capital gain tax applies to individuals, trusts, and companies. A resident, as defined in the Income Tax Act, once again, you see the importance of understanding why you need to know what is considered as a resident for tax purposes. They pay tax on the worldwide assets, so they will pay tax on the immovable properties situated in and outside of South Africa. Whereas a non-resident will only pay tax on assets that's situated in South Africa, and assets are referred to immovable property. And this will then, there's a confusion between the two words. Non-residents will say, but why am I paying? I don't need to pay. Unfortunately, you are required to pay due to the fact that you pay your property situated within South Africa, and the number of double taxation agreements that I've gone through, that I've reviewed, they all state that the country where the property is situated, that is the country that have a right to tax on the disposal of the property, on the gain that was made on the property. So what is the CGT rates? We're looking at CGT rates. This is the effective rate. For individuals and special trusts, we're looking at 18%. However, this 18% can go up to 45% depending on your tax bracket. The reason why I'm saying depending on your tax bracket is because CGT is not a separate tax. CGT is a tax that forms part of your taxable income. So once you determine how much CGT you are required to pay to SARS, you need to add that amount to your taxable income, and that will then determine which tax bracket you fall in. So often you find people, if we take tax residents in South Africa or residents, they will say, okay, 18%, this is what I'm liable for. No, it forms part of your taxable income. And what will happen in that year that you dispose of your property, you will be shifted. So say, for example, you fall within the 18% tax bracket, but because you disposed of a property now this year, it will push you into a different tax bracket, and you will then just the following year, we will go back to your normal tax bracket. Because the CGT, the profit generated on the property will form part of your taxable income. For companies, the CGT rate is 21.6% and other trusts, 36%. So CGT effective rate, people get confused, and you always hear people say, no, companies pay capital gains tax at 21.6%, and other trusts pays it at 36%. But the individual can pay up to 45%. Please note that this percentage was calculated by SARS in a very specific manner. It doesn't mean that you're paying less than an individual. You are still paying more than that individual. Reason being, when you do your calculations, for example, a company, the 21.6% is calculated by 80% times 80% being the inclusion rate, 80% times 27%, which basically gives you 21.6%. So where does the 80% come from? The 80% is once you have established how much capital gain was made on the property, how much profit was made on the property, 80% of that amount is included in your taxable income. And then you need to go to your tax rate, your marginal tax rate for a company, which will be 27%. When we deal with trusts, they are also at 80%, but their marginal tax rate is 45%, which results in an effective CGT rate of 36%. Individuals, all depends on their taxable income. So if you have no income, you have no taxable income, you're a pensioner, or you're below the 18%, once you determine your CGT liability, you will add it, and if it's below the threshold for 18% margin tax rate, you will just pay 18%. But please keep in mind, as individual and special trust, you can go up to 45% depending on your taxable income. So let's do a simple CGT calculation. Okay, so purchase price. You acquired the property for 2 million. There was agent's commission of 100,000, and then transfer costs when you acquired the property was 200,000. That forms your base cost. So what is base cost? Base cost, often you find people use the word, or accountants or people in the tax industry will use this is the base cost. But what is the base cost? The base cost is basically the amount determined after you looked at how much you paid to acquire the property. So how much did you purchase the property for when you acquired it? How much agent's commission do you pay on the disposal of the property now? What was the transfer cost when you acquired the property? Other costs that can be included is, for example, improvements. However, please keep in mind, improvements, it is a very technical definition. While there's no set definition of improvements of a capital nature, but you need to look at, and I always advise clients, how do you determine what is maintenance and improvements of a capital nature? Because only improvements of a capital nature is allowed to be included in your base cost. How do you distinguish between the two? Since there's no set definition or criteria, what you look at, and what I always advise clients is, did the improvements done to the property make a change to the structure? Or did you add something to the property that was not there before? Because some people say, well, I improved the property by painting it. I improved the property by attending to the plumbing. That is not improvements of a capital nature. That is not improvements, that is maintenance. So you need to make sure that you distinguish between the two as to what is improvements of a capital nature and what is maintenance, because only improvement costs incurred for improvements of a capital nature is allowed to be included in your base cost. So now that you've established your base cost, you look at how much are you selling your property for. So in this instance, your base cost was 2.3 million. You're selling your property for 4.6 million. The difference between the two will give you the capital gain. So now you're saying, okay, that is the growth, that's the gain I'm making, 2.3 million. And if you occupy the property as the primary residence, then you're allowed to exclude 2 million. But please keep in mind, and I get this question often, is that if I own more than 2 properties, how do SARS actually know that that's my primary residence? Please note that primary residence exclusion of 2 million is only applicable if you occupy the property as the primary residence. For example, we had I'm not sure whether you guys are familiar with liquidation distribution accounts, but we had an account instance where in the heading of the liquidation distribution account, it states where the person resided before he died. And then in the body of it, where it deals with immovable property, the 2 addresses did not correspond. So SARS came back and we wanted to claim the 2 million exclusion, and SARS came back and said, no, the person did not occupy the property as his primary residence. because the heading where he died, the address inserted where he died, is different to the property description in the liquidation distribution account. So you need to be mindful of the fact that you need to occupy the property as a primary residence to be able to, or to be entitled to this primary residence exclusion. If you occupy the property for a certain period of time, you're allowed to do apportionment. That's a separate calculation. And if you have two owners, if there's one property and there's two parties owning it, a husband and a wife that own the property, please note, not each person is entitled to a 2 million exclusion. The 2 million exclusion is apportioned in accordance to your percentage that you own in the property. So if a husband and wife co-own the property, each person will be entitled to 1 million as an exclusion and not 2 million. So the primary residence exclusion is subject to the percentage that you own in the property, and it is also subject to whether you occupy that property as a primary residence. So besides, in this calculation, I did not include the primary residence exclusion. And then the additional exclusion, which is that we refer to as the annual exclusion, is that each individual is entitled to 40,000 Rand as an annual exclusion. So that will also be deducted from the total gain calculated after subtracting the proceeds of sale from the base cost. This 40,000 Rand exclusion, annual exclusion, increases to 300,000 on your date of death. And death is considered to be a deemed disposal. So on date of death, when you attend your CGT calculations, the 40,000 will then now increase to 300,000. So once you've deducted the necessary exclusions, you will get to actually what is the gain you made on the property. In this instance, it's 2.260,000. Once you've established the gain you've generated on the property, the profit you generated on the property, you will then, in the case of an individual, earlier I explained the inclusion rate, 40% for an individual, you will determine what is 40% of that gain you made. Once you've established the 40%, you will know exactly how much of the capital gain you need to include in your taxable income. And once you've determined that, you take that, apply it to the SARS tax table, add that to your taxable income, go to the marginal tax rate, go to the tax table, and apply it to those calculations provided by SARS. Unfortunately, it's not a calculation. When you look at the tax table, it's not a calculation. It is, as everything with SARS, it appears to be encrypted. So if you need assistance, please contact tax@stbb.co.za, and we will gladly assist you with CGT calculations. So this is basically a summary and a broad overview of capital gains tax, a simple calculation. Keep in mind, before I proceed on to the next slide, that the 40% will be a 80% when you either a other trust, not a special trust, the other trust, or a company. That 40% becomes 80%. So you will take the 2.260,000 and determine what is 80% of that amount, and that will be included in the trust's taxable income or the company's taxable income, and that will then be taxed at the flat rate of 45% or 27%. Okay, so now that we've discussed CGT and have you guys a brief overview of a simple CGT calculation, we're going to go into withholding tax. So what is withholding tax? Withholding tax is basically a mechanism created by SARS to ensure that non-residents account for tax. It is considered to be a provisional payment of their CGT. It does not negate any liability in terms of CGT. It does not replace CGT. It is considered to be a provisional payment to CGT. Please keep in mind that withholding tax falls within under the sections, whereas capital gain falls under the 8th schedule. So there is a clear distinction between where the two sections find themselves in the Income Tax Act, and there is different implications with the fact that it's not within the same category of the Income Tax Act. So Section 35 Cap A of the Income Tax Act provides for withholding tax on amounts paid to non-resident sellers of immovable property. And I often get it when I get in contact with a client, when I reach out to a non-resident client, when they acquire property, they will say, but why are you not taking into account that it should be calculated on the just on the profit, on the gain? The problem with that is when you read Section 35 Cap A, it does not state on the gain made on the property. It states any amount so payable to a non-resident. And because the wording of Section 35 Cap A does not refer to gain, it refers to any amount payable to a seller that's a non-resident. The 7.5%, which is in the case of a natural person, I'll go through the percentages just now, will be calculated on any amount payable to the seller who is a non-resident, and this will be the amount that reflects in the agreement of sale. If you sold your property for 4 million, the 7.5% will be calculated on the 4 million, despite the fact that you acquired the property for 2 million. It will not be calculated on the gain you made. It will be calculated on the full amount that you will receive due to the wording of Section 35 Cap A. The above section provides that non-resident sellers whose property sales fall within the criteria specified are obliged to make a provisional capital gain tax payment to our local receiver of revenue, SARS, with the transfer of the property, and not only at the end of their financial year. So what is the criteria? The criteria, before I proceed to discuss the criteria, I just need to state that with Section 35 Cap A is a mechanism introduced by SARS to put the obligation to make the payment of the withholding tax, between inverted commas, the provisional payment for capital gains tax, on the purchaser, the agent, or the conveyancer. So this liability lies with the agent and the conveyancer and the purchaser. And I will explain later on why I believe it does not, the liability or the obligation does not reside with the purchaser, but more with the conveyancer and the agent. So if you sell your property and your property is below 2 million, there is no obligation on the conveyancer to withhold any funds. So when we speak about withhold and the prescribed percentage, when we deal with a natural person, we are dealing with 7.5%. A company is 10% and a trust is 15%. So that's the various percentages that the conveyancer and agents are required to withhold before they make payment to the seller of the proceeds of sale. If your property falls below the 2 million, if you're selling a property and it's 1.5 million, there is no obligation on the conveyancer, agent, purchaser to withhold any funds. This does not mean that it negates your liability or your obligation to make payment to SARS for CGT. It just means that there's no obligation. The Section 35 Cap A does not come into effect and does not affect the conveyancer or agent or the purchaser. You are still required to submit a tax return and declare the gain loss made on the property to SARS. So withholding tax is in essence a provision for CGT. The conveyancer will have to hold back the relevant amounts in the firm's trust account, just as discussed, the percentages that will be calculated on the amount so payable to the seller before accounting to the seller for the balance of the net or sale proceeds. Payment needs to be made to SARS within 14 days if the purchaser is a resident, or within 28 days if the purchaser is a non-resident. So what's the obligation facing estate agents and conveyancers? In the event that the purchaser of immovable property knows or should reasonably have known that the seller of the property is not a resident and fails to withhold the tax due under this section, the purchaser will be personally liable for the payment of the amount which he or she were required to withhold. The purchaser will, however, escape liability if the estate agent or conveyancer assisted in the sale of the property and they fail to advise the purchaser of the seller's status. My view on this particular provision in Section 35 Cap A is that the purchaser will never be liable for any withholding tax. the liability lies with the conveyancer and estate agent. Reason being, the structure or the way our deeds office is set up, the way our agreements is drafted is that in most instances, the purchaser will make payment of the proceeds to SCBB or to the conveyancer or to the agent, and the funds will be held in the trust account. There is no way where the purchaser will be sitting with the funds and paying it over directly to the seller, unless there's a special arrangement between the two parties. In this instance, you are when they make that payment to the attorney, when they make that payment to the estate agent, you are holding the funds. So now the client is no longer, the purchaser is no longer sitting with the funds, and they're not the ones making the actual payment. In that instance, I believe that this section is slightly outdated, and it merely shifts the liability from the purchaser and poses all the liability and responsibilities on the conveyancer and estate agent. But like I said, the purchaser will escape liability if the estate agent or the conveyancer assisted. And we all know in South Africa, you cannot dispose of a property without the conveyancer. Or in most instances, there's private treaties as well, but in most cases, there's an estate agent involved as well. This section introduces an onerous responsibility on estate agents and conveyancers entitled to any remuneration in respect of services rendered in connection with the disposal of the immovable property by the non-resident. The section specifically provides that both the estate agent and the conveyancer will be legally obliged to inform the purchaser in writing of the fact that the seller is not a resident for tax purposes in South Africa before any payment is made to the seller, and that the provisions of Section 35 Cap A may apply to the transaction. In the event that the estate agent or the conveyancer know or should reasonably have known that the seller is not a resident for tax purposes in South Africa and fails to comply with the obligation imposed under the section, the estate agent or the conveyancer will be jointly and severally liable for the payment of the amount which the purchaser should have paid to SARS. So in this instance, despite the fact that Section 35 Cap A stipulates that if they reasonably ought to have known, that gives room to say that, okay, I had no idea that I was dealing with a non-resident, so I cannot be liable, shift liability back to the purchaser, or I should have informed the purchaser that is dealing with a non-resident. Previously, I mentioned that the purchaser is not going to sit with the funds. The purchaser is not going to pay the funds to the seller on date of registration unless there's a special arrangement between the parties. But in most instances, and it is practice with most law firms in conveyancing for the funds to be paid to the transferring attorney. Based on all the FICA regulations and all these additional duties that has been imposed, at what point can you, as a conveyancer, as a paralegal, as a estate agent, say that I had no idea that I was dealing with a non-resident, when all the FICA at your disposal indicates that there's a possibility that you're dealing with a non-resident? And how can you, from the documents at your disposal, make such a determination? First of all, when they answer your FICA questionnaire, you look at what is the address where do they reside? That's the first. And then secondly, you look at the bank account, the details they provide. Is it foreign banking details? If you pick up that you're dealing with a foreign address, it's not in South Africa, and that you have foreign banking details, I think that should be the indication for you to contact the client and ask the question: are you a non-resident for tax purposes? But be very mindful in this instance, because a client will most likely come back and say that I am a resident for tax purposes. It's best not to do this telephonically, but rather to have it in writing to show that in the event that that client or that seller was in fact a non-resident, you have proof to say that you asked the question and the client answered the question, so you went based on the client's advice or the information the client provided to you. Keep it in writing, print it, put it in your file, because at the end of the day, that can be how you get out of being liable to pay the withholding tax and penalties and interest to SARS. We are currently at STBB busy just finalized a exchange control form, which we will use internally for our paralegals and conveyancers to assist them in determining whether they are dealing with a non-resident, as we want to mitigate every single liability in this regard. The liability of a state agent and conveyancer will be limited to the amount of remuneration or other payments receivable in respect of the services rendered in connection with the disposal of the property. What does this mean? Basically, if the withholding tax, which was supposed to be paid over to SARS, amounts to 300,000, the agent's commission was 100,000, the conveyancing fees was 50,000, the estate agent will be required to pay over the full commission to SARS as part of the withholding tax for the non-resident, which they never withheld, which is the full 100,000. So you, as the estate agent, will need to pay over your full commission to SARS. The conveyancer's liability will be capped at what he she paid for the service, or what they receive for the services rendered. So if their fees was 50,000, they will need to pay over the full 50,000. Section 35 Cap A makes provision that you may recoup these funds from the non-resident. But let's be honest and let's be practical. The client doesn't live in South Africa, he lives abroad. You paid out the full proceeds, you did not withhold. SARS came to you, SARS said to you, you failed to comply with Section 35 Cap A, you had no proof or you did not do a due diligence on your client, you are required to pay over. So the section does cater for, okay, you can still reclaim this back from the client. You can go to the seller and say, I was required to pay this to SARS. Now please refund me my money. But how difficult would it be for you to get that money back from a non-resident in another country? The amount of money you're going to spend to engage legal services to get the funds back is going to, at the end of the day, outweigh the costs or the benefit of getting the money back. So rather do your due diligence and make sure that if you have a suspicion that the person is a non-resident, or not rather suspicion, but there's an indication that you're dealing with a non-resident, contact the client, speak to the client, liaise with the client. If the client is still of the opinion that they considered a tax resident of South Africa, get it in writing, keep it on file. It's in your best interest. This particular section, however, before I speak about the penalties and interest, while you can recoup the withholding tax that you had to settle with SARS now, withholding tax will accumulate penalties and interest from the date that it became due and payable. So, for example, say that you registered the property a year ago, and SARS, for some reason, picked up a year later that you were supposed to pay or to withhold 7.5%. This non-resident never submitted a tax return or declared the sale to SARS. We are now expecting you to pay the withholding tax. In addition to withholding tax, SARS is going to tell you you are required to pay penalties and interest calculated from the date that the funds became due and payable. And as mentioned earlier, it is within 14 days and 28 days, depending on the nature of the purchaser, whether it's a non-resident or a resident that you're dealing with, in respect of purchasing the property. The section is clear that while you can recoup the withholding tax paid over to SARS, which is capped to the commission you receive, and for conveyances, the amount, the fees, the conveyancing fees, you are not entitled to get the penalties and interest or claim that back from the client. So you will need to pay from your profit or from the commission. You will need to settle the penalties and interest pay that accumulated from the date it became due and payable up until the date that you are now settling the outstanding withholding tax. So if there's, I'm pretty sure there's estate agents online. If there is, please keep in mind there is liability for you and for conveyances. So do your due diligence when you have any indication that you're dealing with a non-resident, and make sure that you cover your bases by asking and posing the necessary questions. If you need assistance with this, please contact us at STBB and we'll gladly assist. So it is important that you know that if you do not withhold, like I just discussed, withhold the necessary funds and pay it over to SARS, you will become liable for penalties and interest. So I already covered this slide in my previous discussion. So in the interest will be payable on any amounts outstanding starting from the day following the last day of payment to the date that the amount is received by SARS. In addition to this, the purchaser will be liable for penalties as well. You need to keep in mind that while there's a discretion with remitting or waiving a penalty, SARS does not have discretion in remitting or waiving interest. So you will be liable for the interest. You can always make a case if you have this sufficient reasoning whatsoever for SARS to waive or reduce the penalty. But when it comes to interest, please keep in mind SARS does not have discretion with doing the same with interest. The benefit of withholding tax is that Section 35 Cap A is that it makes provision for the client to apply for a tax directive. So what is a tax directive? A tax directive is basically when the client submits the necessary documentation, makes the application to SARS, submits the calculations to SARS to determine what is the actual tax liability. So instead, if you recall correctly at the beginning, that I mentioned the 7.5% in case of a natural person will be calculated on the amount payable, or the amount that reflects in the agreement of sale. So instead of paying that 7.5% over to SARS, we can assist with doing a tax directive. That's the tax directive basically calculates your actual liability, and this is where the tax directive will look at the actual gain and profit made and not the full amount reflected in the OTP. There's ways of reducing your CGT or your liability as discussed previously, but you need to submit documentary evidence. At SBB, we provide this service. As mentioned previously, we strive to have a one-stop service where we provide umbrella and cater for our clients' needs. We can assist the clients with applying for tax directive at a nominal cost. And this will entail that we get the necessary documentation from the client, we do the calculations for the client, we complete the application, and we submit it to SARS. We will liaise with SARS, and SARS will get back to us, issue a tax directive, and the tax directive will stipulate exactly the amount of tax that the non-resident is liable for. So in that instance, the conveyancer will withhold 7.5% if we haven't received the tax directive prior to date of registration of transfer, but they will not pay it over to SARS, because once you submit a tax directive, it postpones the liability of making payment within the prescribed period of time until you receive the tax directive. At SBB, we provide these services, and if you have any clients that requires a tax directive, please email tax@sbb.co.za. In addition, when a non-resident purchases immovable property in South Africa, please note it is also advisable to have a will that deals with the South African assets. If you're a non-resident and you acquire property and you require a will to deal with your South African assets, especially immovable property, because it can become very complicated when you have one will that deals with your worldwide assets, email estates@sbb.co.za, and they will be able to assist you with drafting your will to cover your immovable property in South Africa. Once again, SBB Direct app, it's a life-changing app. You can download this app. There is eval, reminders, your matters. If you're a estate agent, your matters. There's calculators, there's resources, and there's podcasts. So we also have the information concerning the withholding tax, etc., available on the app. If you're one of our clients that purchased the property through SBB, you paid the fee for the eval. The eval is you can access it whenever you want to. Please make use of it. Please store all your documentation on it. Your inward SWIFT receipt if you're non-resident. All expenses incurred in terms of dealing with the property when you want to improve your property, tenant renovations, upload it onto the eVault and make use of the app. There is resources, there's podcasts, there's information that can assist you. So that brings me to the end of my presentation. I'm going to look at some questions now, and then I will answer it. So I see a question from Shannon Williams. By intermediary in the process is referring to any South African bank. Who else is considered an intermediary in this context? Shannon, so you get authorized dealers and intermediaries. When I refer to an intermediary, this is more the person that deals with the Forex. The authorized dealer is considered to be a bank. The intermediary will be the person that we will liaise with in terms of opening the bank account, getting in contact with you, discussing the exchange rate, and they will deal with the authorized dealers, who is the financial institutions. Lawrence, how easy is it for a non-resident to open a bank account in South Africa, and how long does it take? Lawrence, I don't want to mispronounce your name. It is relatively easy to do that. However, the nature of the bank account is slightly different to a normal bank account. They don't have access to online banking. They will deal with the intermediary who will attend to all their financial needs. If they need to make a payment, they will send an email to the intermediary that has been assigned to the matter, and they will liaise with that particular person. If they do need a bank account, email me once I've taxed at STBB. Once I've gathered information from the client, the onboarding documentation will be populated, client signs, and a couple of hours, unless they are verified or selected for verification, the account can be opened within a day or two. David Lekay, what would the process be to transfer the proceeds of an inheritance to a legatee in New Zealand from a South African estate once the master has approved the final and liquidation account? Okay, it depends, David Lekay, whether the beneficiary is a non-resident, as we discussed, or if he's a non-resident, it is relatively easier, but it's a matter of opening a bank account for them and transferring it either from the estate-led bank account to the the foreign bank account, which is the beneficiary, but it all is centered around whether they're in possession of a South African identity document, green barcoded ID card, or permanent residency. So it falls back to my first slide, and that's why I said it's still important to understand the concept of residency. Then we have a question from Jason Lee. What is the inclusion rate? What is the difference between special trust and other trusts? Inclusion rate is the percentage of, for individuals, it will be 40%, and for trusts, for individuals and special trusts, it is 40%. For normal trusts, other trusts, which we refer to as other trusts, and companies, it will be 80%. So that is the amount that you take. Once you determine the capital gain, you will then multiply that amount by 80% for a trust, and that will be the gain that you will include in your taxable income. You had a second part to this. What is the other trust? What is a special trust? A special trust is a trust created to simplify things, not to go into technicalities. A special trust is a trust created for a person with special needs. There's certain document. It's a very daunting process as well, but that trust needs to be created in a specific way and registered with SARS in a specific way. In that instance, they will be treated or taxed and the same as a natural person, and not on the scale that a other trust is taxed. Tamsin, what estate duty is charged on non-residence members' interest in a SA closed corporation to be transferred to here in terms of will? Estate duty charge in terms of non-residence members' interest? I will get back to you on that question. If you can just send me your email address, then I will get in contact with you and we can address that question, Tamsin. Governor, at what point is the 2 million primary residence exemption deducted from the gain, before or after the 40% gain has been calculated? Kalisa, Governor, it is before you calculate the 40%. Shahida Hussein, if the identity document of the seller states non-resident, then is the seller automatically regarded as a resident for tax purposes? Shahida, so there you need to separate the two. So if you're referring in your question to a South African ID, green barcoded ID as the identity document, we don't look at that when we deal with SARS. That is more for South African Reserve Bank. So it's not automatically that if I have an ID that I'm considered a tax resident. You need to go back to whether the person is ordinary resident or whether physical presence test apply. If none of the above, or if the double taxation agreement did not impact that, or did not make the person a tax resident of another country, then they will most likely be a tax resident. But you need to go on a case-by-case basis and determine. Simplify things. If you haven't been in South Africa for a number of years, you've been living abroad, if your financial interest is abroad, you don't come to South Africa in terms of the physical presence test, you are most likely a non-tax resident for South African purpose. And just to add on to that, often you find that people say, no, but I do pay taxes in South Africa. I'm registered with taxes in South Africa. Please, that is not the indication of your tax residency status, because I can have financial affairs and assets in another country, and because of that, I will pay taxes and I'll be registered with that foreign tax authority for taxes, and I'll pay taxes in that country. But it doesn't mean I'm a tax resident. In South Africa, a tax resident is based on the worldwide income, whereas a non-resident is taxed on the income generated by a source within South Africa. So it's a case-by-case basis, and you need to assess that based on the facts at hand. If you do need assistance with determining this, you're more than welcome to contact us at tax@stbb.co.za, and we can assist you as far as possible. If you're a non-resident purchasing property in South Africa, you do not have a will in South Africa, please contact estates@stbb.co.za. They will gladly assist you with drafting your will. It's important that you do have a will regulating your assets in South Africa. And then if you need access or want to know how to use the STBB Direct app, which is life-changing, please get in contact with us as well. We will assist you as far as possible. Thank you, everyone. Thank you for joining. And if you need to contact me, tax@stbb.co.za. Thank you.